Coming up today, stocks have the worst day of the year as Trump confirms tariffs start tomorrow. Uncertainty at all-time highs, option traders racing for a crash, Nvidia sinks 8%, crypto reverses all of its gains, and is the Fed trying to crash the markets? It's a big day, guys. Let's go. And welcome back to Click Capital, everybody. Another brutal start for the weekend stocks. In fact, it's the worst day so far this year. The biggest fall we've had in 2025, as it appears the market could be testing Trump's resolve to officially go ahead with tariffs beginning tomorrow. As the White House has confirmed a new round of tariffs, starting on Canada and Mexico, both 25%, and China now at 20%. But as you can see, once again, another bit of a defensive rotation. It's really the growth trade coming off hard here, especially technologies and small caps. Russell 2000 now down about 15% from all-time highs. But again, looking technically oversold here, as in my opinion, tariffs going into effect tomorrow is an easy headline for the algos to rug pull this market, as investors are already on edge, and in general, markets hate uncertainty as well. However, I think there's a good chance we could make a low this week on some elevated fear readings, but it could get worse before it gets better, as I'm about to show you why. And yes, I was selectively buying the dip today in some personal positions of mine. And stick with me because I'm going to show you what I think the best opportunities are in a few key assets, in addition to some pair trades as well. But just looking at volatility, we did close above 20 for the first time since the 19th of December when we got that quick fear spike the week before Christmas here. And we do have a little bit of backwardation in the VIX term structure. The 9-day now ahead of the 30-day. And what we'd been looking for was the VIX futures front month to go above the second month, taking this spread above 1, which it had been respecting over the last week, as it had been quite an orderly move in the volatility market. However, now we're in the dicey zone. And this is where bottoms are made. However, like I said, just like we saw in August, it can get a little bit worse before it gets better. But pretty much every fear-induced capitulation in the market will make a bottom when this spread is above 1. But like I said, it can actually spike even up to 108 as option dealers price in a lot of near-term volatility and then for it to sink again a month or two out. And since we're going right into the official start of tariffs tomorrow, we could once again see another rug pull tomorrow. However, it could be a sell the rumor, buy the news day as well. The Mag 7 getting hit hard as a group, down 3.3% today. Interesting to note, had quite a few European stock ETFs finished the day higher. Germany 3%, Spain 2%, Sweden and Poland as well, holding up there. And this outperformance from international markets has been going on a few weeks actually. Looking at the spread of developed markets versus S&P 500. Really came off hard in Q4 last year, but having a pretty decent bounce here. A little bit so on emerging markets, however, still had a big pullback there on Friday, as pretty much half of the emerging markets fund has got to do with China. No surprise to see them pulling back a bit here today as well. But once again, the semis got hit hard. Nvidia down 8.6%, $114 a share. Like I said last week, my buy zone for this stock is going to be in the low 100s. If we get there over the coming days and weeks, we're already technically oversold here, about 12% below the 50-day VWAP. However, just looking back to the 5th of August, and we can see up here as I hover over each candle, we actually got 24% below the 50-day VWAP. So, like I said, it could get worse before it gets better. And if we do get that capitulation, I would love to pick up a few Nvidia shares in the low 100. The market may find support just above 100 and quite often do that, just above a psychological level or just through it. But if we were to keep going through to the 90s, I'll pick up a few more as well, because I think nothing's slowing down AI spending. Understandable why the market's really nervous with this uncertainty around tariffs. However, in my opinion, that's not going to change the huge secular trend in CapEx spending for AI infrastructure. And with Nvidia having pretty much 90% market share on high-end AI chips, I just don't think that's going away anytime soon. But like I said, stick with me because we'll come back to the charts a bit later on and I'll show you some other assets. I'm setting up for a buy the dip, including some pairs trades as well. But just to recap the headlines that are moving markets, along with showing you some data to give you the bird's eye view of what's happening out here. Looks like the day we've been talking about for months now has arrived. No surprise to see volatility in Q1. We'd been forecasting this on the back of the introduction of tariffs. Market might have been hanging its hope on Friday for a last-minute deal. However, Trump confirmed there's no room left for Mexico or Canada. Tariffs are set to take effect tomorrow. And so like I've said before, I think Trump in his second term is going to be a bit different from his first term. He was really watching the stock market closely in the first term, tweeting about it all the time. However, I think this time, since he's not up for re-election, it's all about leaving his legacy. And he really does want to even the playing field with America's biggest trading partners, who on average place much higher tariffs on US goods than vice versa. And so my point is, I think he has a bit more tolerance for stock market volatility. Of course, if it fell off the cliff, I think we'd get the Trump put as well as the Fed put. However, I think now he's more focused on getting bond yields down. But there's one thing markets hate, and that is uncertainty. And looking at the global economic policy uncertainty index, we're now at all-time highs. Once again, not surprising. Kind of in the middle of this storm. May indeed take a few more weeks and months to settle before the market really gets gets its head around it. And who's to say some really good trade deals for the US can't come out of this? As Trump's shown to other countries, he's not bluffing. He's willing to go ahead with it. They might feel the pinch and pain straight away, come back to the negotiating table, and we get that nice headline and a relief rally, which could be a very sharp one as well. Given how lopsided the market's getting here, extreme fear zone, in addition to investor sentiment surveys, there is blood on the streets. No doubt, a lot of people coughing it up at the lows. But once again, it isn't unusual to see some chop and frustration in the early part of a post-election year. It can quite often consolidate throughout Q1 going into Q2. And just looking at another stat, how does the S&P 500 track after a 20% year? Again, we can see that chop in Q1, but on average, the market will slap on 10% after a 20% year. But if you look at the trend most of the time throughout the year, this is how investors get frustrated, because most of the time, like in any market, it's in drawdown or consolidating. And it quickly makes those gains, consolidates, quickly makes another one, and on she goes. But if you were just out of the market for just a handful of these weeks, you'll spend your whole time in chop. And worse, if you're trying to guess if the market's going to go up or down tomorrow, the next week or next month, you just open yourself up for massive amounts of whipsaw. Market can go up, down, up, down, up, down, and you're on the wrong side every time. However, if you're always determined to own assets, got that accumulation mindset, understand what you own, you always buy in the dip in a diversified portfolio, just a matter of time before you'll be right again. And so far, we have kind of been following seasonality this year for a post-election year. We were up in January, down in February, and I know we're off to a rough start here in March. But these oversold conditions just set up for a bit of a bounce. We just need those relief headlines to come through and give the algos another good reason to play a big gotcha on the extreme bearish readings now. And traders are buying more put options. Demand for crash protection soared last week, and I'm sure it did again today when we get the data on that spike in the VIX. But it's the same every time. It's kind of like a lot of traders wait for their house to catch on fire, then they go and buy fire insurance. But as I always say, the best time to buy insurance is when you can, not when you have to. And options activity is ramping up. Absolutely surged since 2020 when everyone was stuck at home. Nowadays, 59 million contracts change hands on average every day. Last month was a record. Options market now 52 years old, and I've been doing a bit more of that this year myself as well, given all the activity. Selling out of the money weekly options, I prefer to be on the other side of all those gambling on them. And I've got to tell you, there is some juicy puts out there today. And no doubt, trading volatility is likely to be exceptional throughout the Trump years. But we're getting plenty of bearish headlines. Nvidia stock sinks, wiping out 6 months of gains as the AI trade unravels. But big headline, but light on details. No mention of the company's fundamentals, just fear of Chinese tariffs. It's not really a big market for Nvidia anyway. They all get sold through backdoors in Singapore, but that's about it for the details. I actually agree with Tom Lee. We're entering stage 2 of AI. It's no longer a cyclical trend, but a permanent shift. And I think even in the case of a recession or bear market, which looking back in history usually only lasts a year, year and a half, we may get a dip in AI spending. However, it'll just ramp right back up as the bull market comes back. And it was reassuring to hear from Kramer today. The economy can grind slowly to a halt in an environment where business people are totally baffled. If it doesn't matter to the president, then there will not be an end to this fear and a concomitant rush to safety. However, if you look at the data we just got a week and a half ago, CEO confidence actually spiked to a 3-year high in Q1 with a significant and broad-based improvement. With almost half of CEOs saying economic conditions were better than 6 months ago, a big increase in CEOs expecting to increase investment plans, with 73% of CEOs planning to grow or maintain the size of their workforce over the next 12 months. And we can see that in this chart here. It really came off hard in 2022, but it's continued its bounce back up, now above 60. And apart from that sharp spike up we got in 2020, we're now back to the levels around 2018, 2017. And this is important and a leading indicator because how CEOs feel plays into their business spending and investment, along with what they expect for profits around the corner. But adding to tariff fears today, we got the ISM Purchasing Managers Index for manufacturing coming in below economist estimates of 50.6, and that was down from the 50.9 in January. However, just looking at the hard data, it's still above 50, expanding, manufacturing still recovering, and just going out to a 3-year chart, one could argue that it may have based out. We got this higher high, which could indicate the start of a new uptrend, and just going out to a 10-year chart. Like a lot of economic data and markets, get these big, long, winding cycles. Up wave, down wave, up wave, down wave. Could very well still potentially be at the cusp of another up wave. As remember, this government is very determined to reshore manufacturing back in the States. These tariffs, strong incentives to do so. And I still believe they'll work out in the favor of the states, better negotiate better deals with their trading partners. We just have to get through that initial shock, uncertainty, mess, volatility, which could very well go into Q2, but I think it sets up for US exceptionalism to continue accelerating on the upside as the roaring 20s rages on. But is the Atlanta Fed trying to topple the market here? Now calling for first quarter GDP to decline 2.8%. Just 2 weeks ago, they were predicting growth of 2.3%. Then on Friday, they trimmed it to 1.5. Now it's down at 2.8. Is the US economy about to go into a recession? And there's a look at their estimates here in the green, along with plenty of financial media and economists downgrading their growth forecast for the US economy as well. All based on tariffs. However, according to Goldman Sachs, the picture isn't so bad. They went on to say, while we expect growth to slow this year, the latest data points are not as bad as they look. Most of the widening in the trade deficit reflects a surge in gold imports, which are excluded from GDP, driven by tariff fears. And weak consumer spending in January was likely driven by cold weather, residual seasonality, and normalization from a very strong pace in the second half of last year. Something I've been talking about as well. The states started off with a big freeze in January. Consumers really went all out in November and December. Likely got a bit of a credit card hangover, but fear not, they will be back. You got to lock the American consumer up to stop spending, and even then they'll still find a way. But all this noise wasn't enough for bond yields to come off again today, continuing to slide across the curve here as markets are getting rattled all over the place. 395 on the 2-year. The Fed's still at 425. All this headlines and fear. Really good excuse for the Fed to squeeze in another rate cut here. Kind of similar to back in September. Heightened fears of an economic slowdown. Yields getting created. Market got what it wanted, then shot right back up. And the further we get away from 425, the more likely the Fed will meet the market in the middle, take us down to 4. And Fed Fund futures, now at about 85% chance the Fed will cut in June, but odds are growing for a May cut. Fed doesn't meet till later on this month on the 19th, and we'll get to hear from Jay Powell this Friday after the jobs report. Unemployment rate expected to be 4%. The US economy expected to have generated 160,000 new jobs in February. No doubt the market will be keen off that this Friday. But I gotta say, as a stock investor myself, I would love another cut in rates come May or June. Be awesome if we got another one in September or December as well. $7 trillion in money market funds. All that money is going to be earning a lot less yield. And with bonds trading up and stocks trading down, all these big institutions that invest off yield differentials, the relative yield of stocks versus bonds has just gotten a lot better and could further improve if the Fed does cut. And in fact, if you look at the PE on the S&P, last 12 months, it's 25. That's about 4% earnings yield. Looking back in the rearview mirror, looking forward the next year, it's a bit over 22, about a 4.5% forward yield. And looking forward 2 years on the S&P, it's a bit above 20, meaning about a 5% yield on stocks. Or you could lend your money to the government and they'll give you 3.95. So the further this trade goes on, bonds rally, stocks pull back, the more these big funds will sell bonds to buy more stocks to rebalance their portfolio. But in the meantime, I think the market is throwing up plenty of opportunities here for us swing traders and active investors. Uranium being one of them. My custom technical indicators firing off buy signals here, oversold, institutional buying. But on other markets, the direction is less clear. Wasn't this an interesting one on Bitcoin? Did get really oversold there mid-late last week. Huge rip up on Sunday thanks to the news. The government is going to go ahead with a strategic national reserve, Bitcoin, Ethereum, and a few others. Got a monster rip up 10%, and obviously a few people knew about it. No doubt. There's probably dozens of people involved in putting this together. Someone told a friend of a friend, opened up a $200 million notional position on 50x leverage, and if they sold out on the news, up about 10%, would have made a quick 20 mil. And did the president's son tip us off this time last week when Bitcoin is dipping? He may have seen this deal coming just around the corner. He posted on his X account, buy the dips. And which it initially turned out he was right. However, the price action, this is pretty challenging as to what to make of it. We just got possibly the best news for Bitcoin. The world's largest government is going to start buying it as part of their national reserve. But we're giving up all those gains after the news release. And Ethereum giving up a bit more. So this is one oversold market. To be honest, I'm not really sure what to make of it here. I wouldn't be buying the dip just because we've had such a sharp reversal off this really positive news. And I know we've got a really weak tape out there today. The worst day in stocks this year. No doubt it should have pulled back some, but to see it lose all of its gains means the market completely just threw out the door the positiveness surrounding that big headline. Another strange one today wasn't really a flight to safety. Normally on big fear days, we can see the dollar rally. That reversed course as well. But maybe a little bit of a flight to safety in gold there. Just popped up a little bit, and crude still came off as well. But we are getting a lot of volatility out there, not only in markets, but in economic data. With the change of government, tariffs, companies front-loading, volatile weather, it's all happening. Actually got a sharp drop in trueflation as well, 1.44%. However, I think this, along with the GDP forecast, is likely to spike back as things eventually normalize over the coming weeks and months. But until then, traders can do their job and help markets normalize, take the other side of risk and take advantage of temporary dislocation in the markets. Just looking at the spread here of the Russell versus S&P equal weight, IWM versus RSP. Technically oversold here, really below the buy-sell band, 5.5% below the 50-day VWAP, negative 21 on the DSI is a huge reading. And looking back in history, this has been a pretty good spread to trade as it has plenty of characteristics of mean reversion. Another spread with plenty of dislocation dislocation at the moment, high beta stocks versus low volatility. What's happened the last couple of weeks has been more of an uncoiling of that high growth trade. And we can see that with that defensive rotation. However, that doesn't last forever. Quite often see this in bull markets. And just going out to a weekly chart on this spread, it is in this big support zone. In fact, we're pretty much at the same levels from that big VIX spike we got last year on the 5th of August. So this could potentially be another pairs trade opportunity and another pairs trade that can kind of hedge further falls and high beta stocks, and something I've talked about ever since it first jumped onto my radar on the 21st of November last year is long the iShares Bitcoin Trust short micro strategy, which is pretty much like a leveraged Bitcoin fund. That's actually been working out really well ever since that big bearish engulfing on micro strategy. It's had a few shallow pullbacks, but if you were to look at this like a stock, down here it was around $11. Right now it's about $19, just to put that in context, the move. So very volatile, but again, if markets really get created, this spread should improve as MicroStrategy's premium gets deflated. And there's that big candle there on the 21st. And just look at that candle today, monster gap up, sold right down to below Friday's close here. But to me, the best long in crypto looks like Coinbase because they can still make money regardless of the price of Bitcoin. Obviously, it's better if it's a lot higher. However, they make money on the trading of crypto, which I can imagine there's a lot of people trading it now. And so long Coinbase, short MicroStrategy, could be another pairs trade that works. In fact, it's still been basing for a while here. But Coinbase is my favorite bet to benefit from crypto, not only in the short term, but long term as well. Exchanges do pretty well. And just looking at Tesla, didn't take out Friday's lows actually. I'm still looking to pick up a few more shares at 270, which we very well could get there this week. And like I said, I'm really looking at the low 100s on Nvidia. I think would be a great valuation to pick up some Nvidia shares at what's likely to be forward to price earnings of 25. In other words, a forward earnings yield of 4%, and those earnings have been growing in excess of 100% per year. Pretty good numbers if you ask me. But like we've been saying, there's so much headline risk out there today. We're expecting more volatility as we officially go into the start of tariffs tomorrow. I'll be keeping an eye on the volatility term structure, and when the front month goes back below the second month, that may give us indication that the market's found a bit of a bottom, which like I said, I think is likely to happen this week. We just may indeed get another spike up to 28 or so on the VIX. If so, I'll be buying the dip once again on a select number of my personal positions, and why it's important to always keep a little dry powder to take advantage of these temporary fear spikes and dislocation. It's the best time to put on pairs trades, and like most opportunities, they are just a fleeting moment in time. That's all for today, guys. Thanks very much for sticking with Click Capital, and I'll see you again this time tomorrow. Cheers.